Is all of this a sign of things to come in the new year? Joining us now is UBS Wealth Management Chief Investment Strategist Mike Ryan. He's going to take us through this and tell us calmly how we should all handle our investments in the new year. It is a bit of a rocky start to a new year to sell off like this.
It is. It's a little bit of a New Year's hangover. You think about some of the things we were concerned about towards the end of 2015, that is how the growth dynamics in the emerging markets, specifically China, would play out, what the effects would be in the developed world. We're seeing that play out in the first part of 2016 as well. I do want to be careful here, Sandra, because while we had the economic data overnight was soft, we have to remember that there's a balance of economic data that overall shows that while the outward-focused parts of the Chinese economy are slowing, what you see is actually the domestic economy continues to do pretty well. Certainly the service side held up. So again, I think this is a bit of an overreaction to a single data point.
It was kind of the words that we heard from John Brady, RGO, at the CME Group in Chicago a little bit earlier. But the focus is now going to be on U.S. data, you say, and we've got a jobs report at the end of the week.
I think there are two critical pieces of data this week, among others. I think the PMI reports, which we get today, is going to give us some sense of whether this slowdown in manufacturing is truly global and widespread, or whether it really was something that was related to China. And then secondly, to your point, it's going to be about the employment report. There is concerns, though, that if the employment report shows weakness, then there's a concern, of course, that maybe the Fed had moved too quickly when they raised rates in December, and we'll be back into this should they or shouldn't they debate with regard to Fed policy. Okay,
so your preferred market, you say, is the Eurozone, which is interesting because there's definitely a theme developing already in the new year, if I can say that. It seems to me a lot of people like Europe right now. It's taken a big hit this morning.
Well, here's the interesting thing. Again, I think the reason that Europe sold off was largely in sympathy with the China sell-off, but also concerns about this ongoing conflict with Iran and Saudi Arabia now, and the potential for that broadening into something bigger. I think what you focus, though, on what's happening on the ground in the Eurozone, it's pretty encouraging. While we're talking about the weakness in the Chinese PMIs, we actually saw the Eurozone PMIs hit 20-month highs. Suggests to us now that the Eurozone economy is finally beginning to gain some traction after this incredibly sluggish period where they simply were faced with so many challenges with regard to the viability of the Eurozone as
So is it safe to say that you would, and I'll open this up to the panel because I think these guys disagree with you, but is it safe to say you would buy a dip like this heading into a new year?
Again, let's see how the next couple of days pan out. I wouldn't necessarily be buying today. I do think that the sell-off is a bit exaggerated, and I think it is a reaction to a single data point. Our views are that the global economy, although it's still uneven, we think the expansion continues, and we think the earnings outlook, while it's certainly not spectacular, I think it's going to be okay in 2016.
My question to you is, over in the Eurozone, we're seeing monetary policies being very easy. There's a stimulus going on. But last year, we didn't see multiples expand. I mean, we look at the German DAX index, it's down off 4% right now, but it's got leading companies worldwide and globally. You've got Bayer there versus Johnson & Johnson here. You've got Daimler over there versus Ford here. There's great multiples and value to be had, but we didn't see it expand last year. Can we see that expand this year? And what's it going to take for them to come off their low valuations?
I think there's two things going to happen. One is I do think the earnings delivery will be there in 2016. So we're looking for low single-digit earnings growth in 2016. But I think what's finally important is that once we see that this is a more durable expansion, you will begin to see some multiple expansion. This is the one thing that's been missing. And I think what markets have been looking for is a show-me moment with regard to the viability of corporate profitability in the Eurozone. I think we do get that in 2016.
Are you making the case that the Eurozone is going to decouple from the U.S. and from China in the face of both slowing at this point?
Well, first of all, I want to be careful in that we're not looking for a global growth slowdown. We think actually U.S. growth will pick up modestly in 2016, and we think we continue to see this management of a soft landing in China. Against that backdrop, with better domestic growth prospects, we think that creates a favorable backdrop for Eurozone equities. Let's also not forget, the point was just made here, we also have a very different policy prescription that's being put in place in the Eurozone. Well, we're talking about whether or not the Fed goes and raises rates again in, say, March of 2016. We still see a very accommodative policy mix in the Eurozone, also combined with very, very low multiples in terms of stock valuation.
So you get a call this morning, somebody's panicked, they see this triple-digit sell-off on day one of 2016. What do you tell them?
It's a long year. This is the first trading session there's 250 or so trading sessions during this year. And what I tell people is not to overreact to single data points or single price moves, especially when you have markets that are as illiquid as some of the emerging markets are. Don't take that as a signal for what's going to happen for the balance of the year.
Good stuff. Mike Ryan, thanks for joining us
Thanks,
this morning.